The Moving Iron Podcast is brought to you by these great sponsors. Are you looking to value your equipment more accurately, target the right buyers and close more deals, reach your ideal customer? Then look no further. Fusible isn't just about ag data, it's about action. Our best-in-class solution empowers you to value your equipment accurately, make informed decisions, and find the perfect prospects. Ignite your dealership's growth at fusible.com/movingiron-podcast. Out in the field, every decision counts. You wouldn't plant without testing your soil, so why would you prospect blind? Introducing EDA, your one-stop shop for ag equipment intel. EDA goes beyond specs and prices. You get deep dive data on every piece of equipment like UCC filings that help track ownership changes and uncover potential sales leads. D&B firmographics, which help you understand the financial health and buying power of potential customers. Market trends that help you stay ahead of the curve, and insights on equipment demands and pricings. With EDA, you're not just looking at data, you're seeing opportunity. Find the right buyer, sell smarter, and build lasting relationships. Visit edadata.com for your free demo and unlock the power of knowledge. For over 80 years, Iron Solutions has been your go-to data source for ag dealers, lenders, and manufacturers. Get powerful appraisal and value forecasting tools that fuel profitable decisions anytime, anywhere. Get your free demo at ironsolutions.com. Iron Solutions, confidence in every click. Today, there are many ways to finance ag equipment, but nobody delivers simple, fast, or flexible financing like AgDirect. Learn more about your options to buy, lease, and refinance equipment at agdirect.com. Valley Transportation has been hauling ag and construction equipment across the country for the past 33 years. Call Parker at 800-657-4910 for all your trucking needs. At Valley Transportation, our goal is to help you reach yours.
When you partner with Axon, you immediately gain access to a full range of products and solutions designed to meet the complex needs of today's grower. We carry all major brands and sizes of tires and wheels. We specialize in large diameter wheels for large equipment. We have one of the largest OEM replacement wheel inventories in North America. Known for extreme flotation setups, duals, and triples, we have wheels for all makes and models of tractors, sprayers, combines, and grain carts. If we don't have the wheel in stock, we'll custom build, sandblast, and paint in-house. There isn't a more vast inventory in North America dedicated to helping dealers move more iron. With facilities on the West Coast and in the heart of the Midwest, leverage our 230,000 square feet of indoor inventory to solve any problem a grower may have. Move more iron with Axon.
Moving iron in the 21st century. Hard-working people working hard for you and me. Moving iron time and time again. Through the years you'll find us here. Moving iron.
Hello and welcome to Moving Iron Podcast. I've got Rich Posson back here again to talk about what's going on in the world of the economy. Rich, how you doing, bud?
Good. Thank you for having me on again.
No, it's my pleasure, man. So the CPI report came out midday yesterday, and that is the report that the Fed uses to kind of judge where inflation's at, and then how they, how interest rates should stack up accordingly. So I guess talk about, because there's some funny math, just like everything. There's a little funny math going on there. The CPI report, Rich, but talk a little bit about what you saw in that report, and then kind of explain, one, how that report works, and then two, how you're looking at it right now.
Yeah. So the CPI stands for Consumer Price Index, and it's an index that you can see has been going up, it seems like, for the entire history of this country. And that does mean things just get more expensive over time. But people then calculate the rate of change of that, so they get a percent. Oh, it's up 3% this year. And then maybe the next year it's actually up only 2%. We get a recession, we normally will get a minus inflation rate. So people pay less attention to the actual index. They get excited about that percent return. This report come out at 0.3% higher in January than February or December. And in my opinion, that's normal range. It's on the high side of that normal range, and I'm talking a normal range back to 2000. So after all that explosive inflation last couple of years, we're back to a normal monthly fluctuation. But it's still a little volatile, a little more noisy than what we've seen in past years. So the trade had been expecting 0.2%. So they kind of got upset that they were off once again and things were stronger than they thought. But it was the annual inflation, and they use an annualized or a 12-month rolling inflation. That did come down from 3.3 to 3.1, but they wanted 2.9, at the very least 3, but they were really hoping to finally break it below 3%. That's what people want. They assume that'll make the Fed happy, and they didn't get it, and it made them nervous. Well, as it turns out, if you look internally in the CPI, all the things that go in, and man, there's like 50 to 100 things that the government looks at to calculate that. I mean, they're trying to figure out what's in the grocery stores, what's going on in the used car sales lot, and these things. Turns out a lot of things were actually up on inflation, so on a percent change basis, and that was upsetting. Well, then they took another look at it and said, well, if this is 12-month rolling, it means we just took out January of last year, which was higher anyways because inflation's been coming down since then. So you took out that high number, and then you added this month's number, which was lower. So that means you knocked the 12-month down, and that's how we get from 3.3 to 3.1. But inside of that, they realized, well, it should have come down a lot more than that, like we thought. And the reason it didn't is we were wrong on all these other little ingredients going into that CPI calculation. Bottom line was they were shocked. Inflation actually went up.
Real quick, Rich. So you're saying all the ingredients into this particular month's report or in general?
And well, it'd be pretty much the same list that they use year after year or month after month of all these things that are calculated. And it's like, okay, well, how much did popcorn go up? How much did soda go up? Right. And they have this gigantic list of this to calculate that index. Then you calculate the rate of change to get that percent inflation that everybody watches. And it turned out
what was wrong? What was wrong in those
many
numbers?
more things on that list actually went up when they thought they would be down.
They were going down. Okay. All right.
And even the things they thought were going up went up more than they thought. Okay. So it scared them. Something's going on. Inflation actually went up, even though the annual went down to 3.1. It scared them. It just made them mad and nervous. Why didn't it drop to 2.9? And then they looked inside and said, oh, we got things going up more than we thought. Yep. And they got to thinking, if we didn't do that 12-month rolling, it may even look worse. Yep. So the stock market immediately, well, what's interesting, as I was watching, it actually sat there. It dropped when the report came out, sat there for a minute or two, like they weren't sure what to do. And then it just sold off for the rest of the day and actually knocked the S&P 500 down as much as nearly 100 points. So it just surprised them, disappointed them, because what they're thinking of is the Fed possibly going to look at this and delay into their interest rate drop even further, because we're now out to May. And there are those who have been thinking June all along. I've been thinking May or June along anyways. But there had been hopes they might lower as soon as March. Now, the last Fed meeting, Powell made it fairly clear probably would not lower in March, but said they'd probably lower this year. Now everybody's nervous. Will they even lower in May, or is this going to drag out on further? So we're back to, once again, the scare over higher inflation. And what's driving people nuts is the private businesses that calculate inflation. They're much lower than the government. So it's got to be really frustrating them to see the government actually showing that the inflation is rising, even though that annual number came down. And the market just didn't like it. The stock market was a little high priced anyways for where it's headed. It was just up a little too fast. And my model is already looking for a setback this week. And I wasn't sure if it was starting that day on Tuesday. And then I saw that number in the morning and I said, we got a down day today. Right. And it was. So, right. Where do we move forward here with this inflation stuff? I don't doubt we can see some seasonal increase in summer. We normally get commodities bouncing a little, and that'll go in and raise it a little, maybe not much, I don't think. And it'd take a big explosive move in commodities to do that. I don't think we'll get that other than maybe in the grain markets. We could get a crop problem that might do it, but a subtle difference. I think most people are more nervous of what are the things that are non-energy and non-food. What are they doing? Although I must say, I saw a chart of commodity prices just going lower and lower and lower here for about a year. Food prices had gone up for a while, come down nicely a few months ago. Now they're already rebounding. They're almost back where they were. So there's this huge spread difference of where prices are being held up in the store, and yet these commodities are going lower and lower. This is a typical behavior. Sometimes it takes 6 months for the cash store type prices to catch up with commodities, but it's upsetting in the sense that what this means is these food companies are making lots of money compared to what they're buying these input commodities for. And but it is normal for them to get away with that for about 6 months. But we're seeing people already saying, why can't they help out and lower their prices? And if anything, that'll make better demand later for the individual commodities, help put a floor price, Mm-hmm. And so it certainly was a nervous report because the problem is too many people were betting it on to be neutral or a little bit favorable for stocks and the economy, and instead they got the opposite. And I don't. It could have been a lot worse. Is how I look at it. So I think the stock market overreacted. Okay.
Oh, they never do that, Rich.
About every other day. So I have to allow for some bumps in the road, and hopefully Powell last year made comments, well, we're going to see bumps in the road, inflation, and hopefully they don't get too carried away here. And I do think later this year they are going to lower rates. They're not going to lower as many times as everyone else. They've warned us on this. And here's something we need to think about, because this is important for the economy. It's important for the stock market. Do we really need to lower rates? Because we've got a record large economy, and we've had mortgage rates at 8%, maybe 10. Okay. And we got the 10-year note trading at 4%. We hadn't seen that in years. It had, but then down almost to zero. So, and everybody's scared. Well, yeah, but if you keep taking it up, it will kill the economy. Oh, yes, it will at some level. But will it kill the economy just sitting here for a long time? And I don't think so. People are still borrowing money. They're still buying homes, maybe not as much as they once were, but companies are still building. Manufacturing is still under a huge construction move here. And I don't know how long that's going to take, and when does that turn into actual more manufacturing jobs? We've had 2.7 million people just retired here recently because of the rise in the stock market, or at least it coincided with that. The stock market suddenly does better, and next thing we know, we got more people retiring. But that keeps the labor market tight. Does force companies to pay a little more. But I think these companies are kind of rebalancing now, where I'm not too concerned of them paying too much to people. I don't think it's going to hurt their balance sheet. They've made enough profits. Some of these companies are doing quite well. So they've been able to make money out of this inflation. So they got a cushion there that I don't know. It just feels like to me, if you go back 100 and some years and compare the stock market and economy to interest rates, we're kind of back to normal average interest rates for the history of this country. And you can find many years the stock market actually did very well. You made 20%, 10% a year, things like that. And the economy grew. So we may be overreacting a little on this interest rates. And there's even discussion of what if the Fed kind of promises lowering, but they never really lower that much. What if they really are thinking they actually got a gift to get interest rates high enough to prepare for the next future recession, that they have room to lower those interest rates, help out the economy, but not put interest rates back to 0% again?
Well, of course, yeah.
And that makes sense. I mean, that should be their job. And they know they have to help out, lower the interest rates. But once the economy's moving, get those interest rates so you have another cushion so we can keep this system working, keep the machine going. We don't want a part of that machine breaking. Yep. And so, yeah, I'm betting on the downside of interest rates in the next year still, just like I've told you for about a year now. I think it's working for us. but I'm not that concerned if they don't go as low as some people want. As long as we can back them off some and then have some stability, I'm fine with it. And I definitely don't want rates going up, and I just don't see that. But I do think the Fed's going to say, boy, this economy is strong. It's going to hang in there. But we should be so thankful over that. And that's why I think we're going to learn in the next few days, stock market goes up anyways. It gets over this saying, well, this was more of a short-term sell the news thing. Long-term, we have to focus on the fact the economy is growing and looking good.
So you brought something up that I didn't think about before we started recording this, but so here we are. We're about a year to where they've about a year, I guess, almost, where they've really tapered back what the Fed was doing with interest rates as far as raising them. It's been 4 or 5 months now since they've raised anything. Any rates have been kind of consistently even across the board now for that amount of time. When you're looking at housing, obviously, when interest rates are 2.5%, you can afford to buy a lot more house because of how their payment structure comes out and those kind of things. Are you seeing a dip at all out there in the value of real estate associated with where we're at with interest rates now? Are you seeing, our houses worth 80% what they were, this time last year type of thing? Are you seeing anything like that pop up in your real estate business?
Not locally, actually, but I don't know as we ran prices up as high as some of the rest of the countries. I look nationally. Yes, I think the raise in interest rates cooled it off a little bit. I wouldn't call it a cool market, but it's not a hot market anymore. People are shopping more. They're trying to get the price down, and we do have lower prices. There's homes selling for 10% less, and I've been concerned with the idea of lower interest rates help build a bigger home. Boy, that is true. That's spot on. So why wouldn't higher interest rates now reduce the size of the home? We're seeing some discussion of that as well, but I was concerned it might make it harder for that home that was recently built in recent years, so large, it might have a problem selling. Well, if you scale up, you can see better bargains the more expensive the home. The $1 million home off 10%, but the $300,000 home off 2 to 5%. And then we got mansions out there. One just sold for like half what they paid for it. It was like a $100 million home. They sold it for $50 million. So
a bargain.
So, anyways, that's yes. There's that kind of thing going on, and you can watch the weekly mortgage things, which are so volatile and crazy that I don't know if it's worth predicting, but it is kind of fun to watch. If interest rates went down last week, this week we'll see that they took on more mortgages, and because they were so pleased to get a little bit of a break in the interest rate. So you can just see there's shopping, but you can also see the demand is still there. It's not a poor real estate market at all. It's nothing like 2008, 2009 when we saw 90% down in some real estate, and China's seeing 90% down. They're living our 2008, 2009 business. So there's nothing scary to me on the real estate and in terms of impacting our economy. Totally different story than what we had back then in the financial crisis in 2000s. But at the same time, if I'm going out there and buying a house today, I'm willing to gamble of, it was only 12 months ago, people were scared to death to even offer a lower price because they thought they'd miss it and they wanted it. So they'd just pay full price. Sometimes they'd even offer a little bit more. Sometimes they would get in a bidding war. You don't see that anymore. Right. People are saying, okay, that's your price. I'm going to offer a little more, and then let's wheel and deal. See where or a little less, and then let's wheel and deal. So the the environment has changed, but if anything, we're kind of getting it back to a normal real estate market.
Yeah. So with what you're seeing right now, with the way interest rates are and profitability that we're talking about, and the stuff that we're seeing happen in China, we're starting to see more countries like Vietnam and in India where some manufacturing is starting to kind of progressively move to those areas. A lot more manufacturers coming back onshore in the United States. I guess as you look in your crystal ball here, Rich, out in the future, do you see more manufacturing coming back to the United States because of the current situation where pricing's at? And just freight costs they're still high. They're nothing like they were during COVID, but they haven't really come down that much. I mean, from what they were, it's amazing what you get used to, I guess, now.
Yeah.
But as you're looking at manufacturing stuff, do you feel like there's more of an opportunity for manufacturing to come on shore in the United States, or do you think more of that we're just going to pick the new Mexico, the new China, the new whatever, and just reinvest in those places?
Well, we're going to do both. I think we're going to get some more just because this manufacturing they're building, I suppose it could be upgrading more than that I'm aware of. And if so, there's going to be a lot of people caught off guard. If it was just upgrading, then all you're doing is moving your employees from an old plant to a new plant.
Right.
And so you didn't gain anything. You didn't add value to your economy. You spent some money to build something, but that was just a short-term thing. I don't think that's where it's going. I do believe some of these manufacturers have not only cut back from China, but they're going to cut back some more. But we're not going to get a gigantic gift out of this either. There's a reason Mexico has done so well. I mean, we know we're sending more business to Mexico. We're backing off on China. And we know other countries are doing the same thing, shifting things around. And I'm very positive on India for the next 20 years, maybe 30. Some people are even talking 50, but I'm going to give it 20 or 30. And then, believe it or not, later this century, I think Europe's going to surprise people. I know a lot of Americans like to beat up on Europe. Oh, they're too socialistic. I don't work hard enough, or there's that. And they've really been wrong, but they've been right in the sense they don't catch up with the U.S. But the U.S. is its own little world of how we do business, and it works for us, but it doesn't necessarily work for others. But yeah, someday we're going to see more business over there in Europe and then picking up. But first, it's going to be all about India, I think. So China has pretty much peaked out of being the real popular place to rush and do business. And I think they're waking up to that. Okay. I thought it really hit them too hard, too fast, too soon, but that was part of the trade war. And then this frustration over globalization helping some people and some businesses, but not helping enough of the others. And so we got this disenglobalization going on. I hope it's not going to turn to deglobalization. I think that's going to cause some recessions and stuff. And I don't think it's going to. I think that's why, yes, all we're doing is shifting from one country to another country. And the U.S. is doing the same thing. We're sending more to Mexico. But to answer your question, yes, I do see us adding more jobs here and building something in our own manufacturing, primarily just because of this construction that's going on. And I just don't see how that's nothing but upgrading. If it is, then apparently we're just going to keep the other countries on board here. But I think it's a combination.
Yeah, there's no lack of construction. I mean, I'll tell you what, you go anywhere you go, any major city you go to, even when I go back home to like Wichita, the amount of subdivisions that are going up, the amount of commercial projects that are in play. You go to, Denver and that area and stuff too. They're just building subdivision after subdivision after subdivision. And they've been doing that for, 20 years. But the amount of infrastructure that you're seeing go in is it's showing you where someone's buying these houses, right? And they're not where they're coming from. It's not like there's a lack of supply when you like the real estate side you're talking about. It's not like all of a sudden there's we're going to go, all these people have these houses here, now they're going to move over here, and now there's just a glut of inventory sitting out there. You don't see that out there. So there's people moving in from different places or what that is, I don't know, but there's not houses sitting empty, I guess is what I'm saying.
Yeah. I do think the construction side of things, and I've built new homes over the years, and I can see it. I'm building one now. Hopefully it's going to get finished here in another month or so. But it does feel like contractors, the fairly good sized contractors, are being more careful not to build too much inventory. I don't know if that's because they're not speculating on their own as well, and they're just waiting for people to come through the door and say, I'll build you a home. But again, that's what happened in the 2000s. I mean, I can remember I lived in Florida then, and they'd come in and just put up 50 homes practically overnight. Well, 10, 20 of those homes were actually speculation on the home contractor, and then the rest were ordered. And sometimes you get too far with that speculation, and it was like overnight we went from 2 months of inventory to 6 to 8 months. Then the recession hit, and it went to 12 months. But it was also fascinating how quickly that inventory came down, too. Right. So it only took a year, and they were down to like a 3 or 4 month supply. And everybody said, that's not bad. There's no reason to panic over that we're going to have lower and lower home prices and have too many homes. And it was interesting. As long as the population's growing, it's interesting how much we can soak up of homes. It's just, boy, that 8 to 10% mortgage stuff, though, that's that causes a lot of people to rethink whether or not they can do a home. Right. So you start seeing those 7 to 6%. I'm guessing you'll see the mortgages pick up and the homes are going to pick up, that kind of thing.
Which that same topic always surprised me too, because I'm looking at my interest rate on my house at 2.75%. In order for me to go buy a new house or build a house or anything like that, I'd have to be downsizing because my kids left. But and I'm a long ways from that. But it's just one of those deals where you look at the situation that you're in and you want to go out and buy that 5-acre lot someplace and build your house out in the country. I don't see how it works. I don't see how you can, but to your point,
I'm glad I locked in when I did, but here's, but that's it. Yeah. But to add to that, there are statistics showing how well the consumer had locked in rates all these years. There's always somebody that, they went for the let it float, I'll lock it in later, and then they got clapped. Mm-hmm. And the other day I think it's over 60% of the corporations, might even be over 70% of corporations, are mostly locked in rates and locked in lower. Mm-hmm. So really the private sector did fairly well, where it might have just been nothing but luck, but they were able to miss out or protect themselves from a lot of this run up in interest rates.
Yep.
It's really the government that kind of messed up and not locking in enough. Yep. They fell behind. The private sector actually did pretty good. But I think it's because the private sector had long been in a mood of, let's not gamble on it. Let's just lock it in. Right. These rates are historically low. Let's not try to be a genius here. And it locked in. But anyways, that provides us a cushion. And I also saw, even on a global basis, some of these global companies really are well positioned that this rise in interest rates did not. Some of them didn't hurt them all, and they have debt. It didn't hurt them all because they were locked in. Yep. Now, you could argue then, did the Fed really make the impact on lowering inflation? And I don't want to rain on their parade, because I'm sure they're saying, look at this chart. But we were successful. Well, they did make an impact. But you and I helped make an impact. We complained about higher prices. The company started bringing them down. We were careful how we spent our money. It was the free market system starting to bring that down too, and so, but then this also brings in the issue that if inflation comes roaring back, then the Fed's going to be really concerned. Yeah, maybe when they raised their rates, they were nowhere near high enough. And I'm sure, and this is going to has the stock market a little nervous at times, but you can argue, okay, if the Fed's at 5.5, 5.25, why are we still knocking out all these great jobs reports and everybody's doing great and everybody's building and these businesses expanding? It didn't make the impact. Okay. So then they get nervous. Well, what if inflation just came down for nothing more than pure luck? And someday it starts up. Boy, how high do we have to take rates to kill it? But also, is it possible the only way we can kill it is we do have to have a recession? Well, I may be awful brave here, but I think if that scenario is coming, it's coming like towards the end of this decade, because I still say that's when we'll get a recession. And we have to have bad news at that time, so I can go ahead and forecast when we're going to get that bad news. I know somewhat type the news, but I may not today be able to tell you the detailed story and later learn it was correct. And I don't need that right now. But that could be a story later this decade. We do see a surge in inflation. The Fed raises its rates only that time. They're going to find out it worked, we don't have a soft landing. We go into recession. And that may be still the best thing for us. We clean it up, we go back to work, and next decade will be better. But to me, for these people who are scared that this is still going to blow up on us next few years, I'm just not seeing it. And these people are scared of all the debt and all the money printed and this and that. You got to realize the Fed actually took money out of the system. They didn't just raise interest rates. They've taken money out of the system to help do it. That may have actually lowered interest rates a little better than or lower inflation better than the interest rates. I don't know how far to push that idea, but I got to remain
I thought I had that turned off.
I got to remain optimistic here where we're headed in the next few years here on the stock market, the economy. And I still think this bearish news that in the past led to several months, even a few years down in the stock market economy, it's only going to knock us down for a month or two. It's going to be a throttle up, throttle down process. And that's always how it's worked. I think we're in a standard operating procedure here right now. And this news is just meant to scare people on a short-term basis. But my modeling is going to point out, hey, they might sell next 2 weeks. And then later it'll point out, say, hey, they might sell the next 2 months here. So this gives us an idea when to look for that bad news, do the math. Do we want to do something about it? Or is it one of those things we know it's going to occur, but we're not going to do anything about it? We're just going to write it out because we want to stay so focused on that long term. That's still very high probability. I mean, even with this CPI report, confusing them, upsetting them, you can argue it itself was a sign of a still strong economy. And do you really want to bet against that? Old man J.P. Morgan back in the late 1800s, early 1900s, he said, don't bet against the U.S., okay? Even though there were crashes. And he even bailed the entire country out a couple of times for crashes. That's how rich he was. And then he got tired of that and started what's called the Federal Reserve. So let somebody else bail the country out.
Yeah.
So, but anyways, we're going to get unsettling news from time to time, but I think we're going to hang in there at about a 3% GDP. I would love to see a 4% in coming years. And this year we might even get close to it still. I hope we behave ourselves. I hope we behave ourselves in the sense of companies as they see their overall business picking up. Will they reduce the margin per unit of production? And yet, because they're now producing more, they still make an adequate profit to keep them happy, keep their investors happy, keep their employees happy. What that will do is hold back the inflation, but the economy moves forward. And I really think that's part of this machine. I think we can get it done, but I don't know if it's consistent enough to assume, don't worry about anything and it's going to happen every month. If those companies come in saying, we're producing more, prices are going up because of inputs, let's take it up even more and we'll make even more. Oh, we're in trouble again. We'll see that inflation bounce like it did in the last couple of years. But it appears to be a movement to fight that. And there's economists going, as you and I discussed in the last 2 months here, there's economists out there. Well, Mariana Mazzucato and Isabella Weber, especially Isabella Weber, she's more narrow focused on just inflation, whereas Mariana Mazzucato is looking at other things such as how do we save capitalism and treat people more fairly and include the middle class and poor, maybe slow down the rich. How do we though create real value out of all this money that we print? Because a lot of this money just goes to the rich. It really doesn't create anything. It's an inefficient system. So at any rate, when they're targeting inflation, they also are looking at how can we detect these companies are making too much, because you don't really want to interfere. But at the same time, if all these companies are doing it, man, we're stuck with high inflation. And if you're going to raise those interest rates up, then yes, you do destroy the economy. But is that really a smart way of doing it? It seems like we can temper inflation and still keep the economy. And so those are the things. And boy, Isabella Weber has met with several central banks around the world, and she's getting positive response where they say, we want to look into this. And in Europe, they're already telling, some of these companies that deliver stuff to their grocery stores saying, we know what your profits are, and you just raise this again. You're not selling it. You're not even putting it on our shelf. I mean, I've never seen that in my lifetime. People have always complained of higher prices, but I've never seen a grocery store say, we're not even going to sell your product. And I know some people won't care to hear this. They won't like it, and they think it's interfering with free market. But we've got a little bit of a broken free market system here. So if we can behave ourselves, that's the best way I can explain it. If we can behave ourselves not to boost inflation, we've got a Goldilocks scenario setting up, but this economy is really going to grow and this stock market's going higher, much higher. By the way, if we have a minute here, I'll talk a little on the stock market. There's a lot of talk about this AI being the big boom driver this year or this decade, I mean. And I think it's obvious it is. It's questionable, how good it is. Is it going to finish with a crash or something? Because what they're doing is relating it to 1990s when we had the dot-com. And for most people, all they think of is, the dot-com, that was a bubble. It burst. We had a terrible time in 2000 to 2002. We did, and it crashed the NASDAQ stock market by 85%. But if you go back and look at the overall stock market, it didn't. It was just a normal setback, a normal recession. So it was just a weird thing of those high-tech stocks, the internet stocks, they just blew out, okay? And I correctly called it then saying, you know what, we're going to put the stock market right back up again, and then we're going to have the super cycle downturn. And that's how it worked. We put it up, and then we dropped it down in 2008, 2009. So I was right in recognizing that. But I think a lot of people forget how good it was in the late 90s. I did too. I didn't realize this till just Sunday. I was sitting down going over charts back then. And I thought, oh my gosh, this market went up like non-stop from 1994 to like January 2000. And then we had the Y2K, you may recall. Sure. Oh, yeah. And that knocked it down. And then the next thing come in. And it's interesting. It's just like commodities. You get these storms where it's nothing but bullish news after news after news. Next thing you know, it's nothing but bearish news again and again. Stock market does the same thing. Economy does the same thing. Anyways, I did some analysis from 94 to 96, and at least in that 94.5 area, which I believe we're moving into now, if this is an analog, if we're kind of repeating or rhyming with that, except it's an AI story and not an internet.com story. The stock market went up 10 months pretty much nonstop. That's just fascinating. I thought, and I realized I was just getting started in some business, so I didn't have much money to invest in stock market, and I was so into commodities that I really didn't think of using my modeling to help with the stock market back then. And I'm sitting there thinking, I could probably have an extra $1 million right now if I just done that in the 1990s, Yeah. So that's fascinating. And so now I'm wondering, do people really remember that as well? Because we have a lot of skeptics out there too, but there are people who are saying this is going to be one of those, and they are really getting bulled up on the stock market. I don't know. I think it went up 256% that decade by my calculations, which could be different how Wall Street does it. Lots of times they use the close of the year. I use the lowest price and link it to important business cycles. But I don't know if it's going to be that bulled up. It would be really something, and it's allowable. It fits with some of my calculations years ago, but I don't think we're going to go that crazy with it. I think analysts back then, they did not know how to price. A lot of those internet companies were brand new. They said, we don't have companies. Like, well, what do we compare this to? So they got caught in a rut that, hey, if the market's still going up and we're saying it's an overpriced company, they got scared that they weren't calculating it right. So they raised their estimate up. Well, that just encouraged people to shove the internet stocks even higher still. So it became a chasing race game. And then when it blew up, suddenly these Wall Street companies said, you know what? Our analysts were wrong for doing that. They had it right. These companies really weren't worth that, Mm-hmm. And I think we'll be far more cautious with that. Nevertheless, I think this is going to be the story. I think this AI can be big. I don't know how big. I don't know how long it's going to last, but I'm pretty optimistic here in coming years. But I'm going to do the best to show when we have little dangerous moments and when we want to do something about it and help out my subscribers and clients as best I can to keep up with the twists and turns. And that's how I look at it. There's going to be lots of twists and turns, but I got to be bullish for a few years here and give this a chance. I'm sticking with my plan. 2 thumbs up on the economy and the stock market. Interest rates, they should go down into next year, and then we ought to look out that they'll probably be up in 26. By the way, crude oil, even though I think it's going lower in the next year, may only go lower to the end of this year, and it can bounce in the summer first, then come down. Gasoline's already bouncing, but it's doing what it normally does.
Yeah, seasonal stuff.
This time of year. Yep. So, give it a chance to go higher in the Memorial Day. Then my guess is that you'll actually see the gasoline futures come down, but at the pump, it may still go higher or stay there. They kind of do that, get the price up ahead of time. Then when we go into driving season, they don't raise it on us. And when we feel lucky, they didn't. And then they've already made their money. They already ran the price up. Right. So we can see that kind of scenario. But I think crude oil will drag its feet there. We have plenty of oil around the world. Just look at this Middle East. Every time something blows up.
Nothing changes, man.
Yeah. It hardly gets out of its own way. So now, but here's something interesting I learned in recent days. EIA, the big energy division of the government, was out and said they see maybe tighter oil supplies. And I'm assuming they're talking the country, but they may be talking world too. But they said maybe late next year and on into 2026. So what they're saying is we're producing a lot of oil. We're drilling more oil, but they're saying the demand can pick up enough that maybe we're not drilling enough to keep that cushion. So I looked at my business cycle and it's saying, well, yes, prices can go down into next year, like we said. They can go down only to this fall, and they may be up. But the model is saying prices ought to be up late next year on into 2026. And it's saying that for commodity indexes. So that gives us a clue for other commodities. That's when we may see a tick up in inflation and interest rates in 2026, is my guess. So that's also to think of something if you're one that likes a big up move in oil, want to speculate on something, or you're just fearful of hurting the economy. I don't see the oil. Oil would have to go to $100 or higher to hurt the economy at this point. We're too strong. I forget what that means at the gas pump, but if it takes quite a while to get to 100, then it'll probably sneak up on the economy, won't hurt at all. If it exploded to 100, that'd be a different story. That would just shock people into looking negatively. But at these price levels, it's a green light for a growing economy, and it can move up a fair amount, and I'm still going to have a green light for the economy. Dollar index long term, this is a weird moment for me. I normally have an opinion long term, but I don't know whether it's going up or down or not for this year.
Nope.
And
look at anybody. No one knows what's going on with the dollar.
So I'm just watching the smaller swings here, and it should back off in the next few weeks, but it could be higher later, lower. I guess how I'm looking at it, as long as it doesn't move up a huge amount in a short period of time, I'm not going to worry over the economy and stock market. If it goes lower, I don't think that's a bad sign. It could be if it did fast, but I think it's okay. And if it goes lower, I think it also helps the global economy. And then, of course, in theory, it ought to help our exports and commodities. So I favor personally going lower, but my forecast is kind of iffy there. And it does watch the interest rates pretty close. But on that interest rates, probably higher into March, but I can see it. It's already bounced very well off the CPI report. It's already going higher into the CPI report. It may not go that much higher into March. I think lower later in the year. I'm still long-term bearish interest rates into next year. I'll stay with that. I think what occurred is they put the bond market got it wrong and put the interest rates too low, too fast ahead of the Fed. And now they're bringing that back up. I think they're ready to take them down because I think they're convinced the Fed will still do it by May, June, and they think that's fine. But they got a little problem right now. Anytime the government has to sell bonds, notes to raise money, we do have an issue that the demand isn't quite as strong or our supply is a little too much. So that can support these rates from time to time along the way. But ultimately, we'll work these rates lower. So I don't see, I'd love to tell you, got a nice drop in rates coming in the next 2 months and we're all going to be happy-dappy. I think it's going to be a bit of a struggle for a while yet. But I do think the Fed lowers, I'll say May, June. I've been saying May, June for quite a while. I might want to be safe and say it's in June. And they'll lower a couple times more than after that. And I think they'll help us out next year. But we need the inflation to behave itself. And some of these private sources, they have inflation much lower than where it is. But now the problem is, are they off and it's going to rebound some? And then that helps explain why the government doesn't come down very fast. Okay. And that was another thing of last week, the government came out and said they did some revisions in how they calculate inflation. For some people, they thought that meant it might drop a little more. So I think they got even more discouraged this week that instead it looks stronger. Do keep in mind this report, inflation, is not, that comes in second place for the Federal Reserve. The Federal Reserve likes the PCE, Personal Consumption Expenditure Index. That kind of shows us how much people are actually spending out there, and they calculate even income, how much money do they have, and compare it to that. The Fed likes that better. That's number one for them. And that one's been coming down low. It's always been a little lower than the CPI, and it's coming down a little better. And some people are saying we might see that kind of offset what just happened to us in the CPI. So here's hopeful. That won't come out to the end of the month. Okay. And then late March 20th, we have the Fed Reserve event, which I think for this economy this strong and this inflation report, they're not going to lower rates. And they warned us on it. That's what upset the market a few weeks ago. And then the market got over it. And that's the problem. You come up with these things that upsets the market, but it's just very short term. And the reason is they finally step back and say, but does this change anything long term? And the answer is no. Economy's moving forward. People are making money. And if they make money, they spend it.
Right.
Americans are good at spending it.
Yes, they are. Yes, they are.
So I don't know what else to add this. I don't know if you got any questions, but I'm still optimistic of the future. But yes, don't be surprised. Stock market dropped some in March. It's going to be normal operating. I'm guessing April, May, record high price. And I'll fine tune that. And instead of guessing, hopefully make an intelligent decision for my subscribers. And we'll go from there.
Okay. No, Matt covers the list I had, so we're all in a good place. I gotta say this real quick here. Moving Iron's official data partner is Fusible, home of Iron Solutions and EDA data. Ignite your dealership's growth at fusible.com. Rich, tell everybody about your podcast and where they can find it.
Yes, go to criticalpointpod.com. You'll find some things about myself, the modeling. I do some blogging from time to time, put a little free stuff, but there's a tab there you can click on that'll take you right to the site of videos and audios. And there is some free. Most of it's locked up, but you can subscribe there and you can listen to the free ones, watch the free ones. But there's also another tab at my home site that will just take you right place to sign up. And it's about $28 a month. And that's darn cheap for what I cover, because I look at interest rates. I look at the economy. I look at gold, Bitcoin, oil. But my focus is more on the stock market and the economy, and then the three grains, corn, wheat, soybeans, and I have a few other commodities I look at. But I'm updating every morning. Audios, I try to keep it 5-10 minutes. Video on Tuesday will go 10-15 minutes. Thursday, I add a weekly update. That one can be 30 minutes to an hour, but that's where I'm trying to cover everything from very short term to very long term. And I help my client base and customer base. And I say clients because I have some money that's linked to my accounts that if I buy something, it automatically buys for them, things like that. I basically help people that are interested, sometimes in very short-term stuff. Quite often I try to say this is an up day or it's going to be a down day. But my real focus is on the more important trends during the year, something I can sink my teeth in. I want the steak and baked potato and the dessert. Okay. I don't want a little snack. And then I really enjoy the long term. I want to come home with the trophy buck. Okay. Right. And so I look at long term where, believe it or not, I even have a decade buy or sell signal. And that thing has helped made me. There's some decades that made like 500% of the stock market, and the stock market did 250%. Things like that. It's a weird one. I don't know. I think I'm the only one out there that says, well, I can buy or sell once a decade. But I add that. But I also try to keep up with these twists and turns along the way to hopefully make things better and at least have an understanding. Why are we doing this? What are we up against? So that we can remain calm and disciplined to follow through and achieve our goal of making some dollars this decade.
Yep. Okay. It's good stuff. If you guys haven't checked out Rich stuff, go listen to the free stuff first and just hear what he has to say. Those quick 5 to 8 minute updates that you put out daily out there, whether you're talking commodities, you're talking stock market, whatever it might be, all of those things. I mean, it's really great information. And then check out what he's got over there on his website. And that's Critical Point Pod. Say it one more time.
CriticalPointPod.com.
CriticalPointPod.com. So check that out. Rich has got some great information, man. He's a hidden jewel out there that not a lot of people are doing, and kind of like a few other people on this podcast, he's saying stuff that's very contrarian to what you see out there in the world market on what you see on the news. So, Rich, appreciate you being on the podcast, man. We look forward to having you back next month.
Thank you very much.
Right on. I'm Casey Seymour with Moving Iron Podcast. Check me out on Facebook, Twitter, and Instagram at Moving Iron LLC. Go to LinkedIn at Moving Iron Podcast, the YouTube channel at the Moving Iron Podcast YouTube channel. See the video version of this, and check us out on TikTok and Snapchat as well at Moving Iron Podcast. Go to the Moving Iron Podcast YouTube website. Just got a new one up there. That's movingironllc.com. Totally revamped for your viewing pleasure. So check that out. And you'll be able to see everything Moving Iron related there. The information for the Moving Iron Summit will be up there here shortly with how to register and those kind of things. Rich will be there doing a little breakout session of what he sees happening for the economy moving forward. So looking forward to that. And anything else Moving Iron related, you can send me an email at movingironpodcast at movingironpodcast.com. If you've got questions, whatever it might be, hit me up there. You can also send me a text message at 308-225-3305, and I'll be happy to get back to you then. So with that, I'm Casey Seymour with Rich Posson. Let's move some iron, folks. Out. The Moving Iron Podcast is brought to you by these great sponsors. Are you looking to value your equipment more accurately, target the right buyers and close more deals, reach your ideal customer? Then look no further. Fusible isn't just about ag data, it's about action. Our best-in-class solution empowers you to value your equipment accurately, make informed decisions, and find the perfect prospects. Ignite your dealership's growth at fusible.com/movingiron-podcast. Out in the field, every decision counts. You wouldn't plant without testing your soil, so why would you prospect blind? Introducing EDA, your one-stop shop for ag equipment intel. EDA goes beyond specs and prices. You get deep dive data on every piece of equipment like UCC filings that help track ownership changes and uncover potential sales leads. D&B firmographics, which help you understand the financial health and buying power of potential customers. Market trends that help you stay ahead of the curve and insights on equipment demands and pricings. With EDA, you're not just looking at data, you're seeing opportunity. Find the right buyer, sell smarter, and build lasting relationships. Visit edadata.com for your free demo and unlock the power of knowledge. For over 80 years, Iron Solutions has been your go-to data source for ag dealers, lenders, and manufacturers. Get powerful appraisal and value forecasting tools that fuel profitable decisions anytime, anywhere. Get your free demo at ironsolutions.com. Iron Solutions, confidence in every click. Today, there are many ways to finance ag equipment, but nobody delivers simple, fast, or flexible financing like AgDirect. Learn more about your options to buy, lease, and refinance equipment at agdirect.com. Valley Transportation has been hauling ag and construction equipment across the country for the past 33 years. Call Parker at 800-657-4910 for all your trucking needs. At Valley Transportation, our goal is to help you reach yours. This podcast is proudly provided by Axon, helping dealers move more iron for the past 100 years. Find out more at axontire.com. Move more iron with Axon.
Moving iron in the 21st century.